You might end up holding for too long because you don't have enough risk to reward ratio. You want to get a bigger winner. You want to leave 10, 15, 20 shares for an all day runner. And because of that, you end up getting trapped in a reversal setup and you give a lot of profits back. And you know what's the worst part? The worst part that you could do is leave a part of your shares for a bigger run. You might be thinking that it's okay, it's only 20 shares, and if it goes against me, I'll exit at break even. One trade like this is okay, but getting 10, 15, 20 trades, 40 trades like this, where every single time you lose 15 to 20% for a runner, then 1 out of 10 trades, you will get a runner. That's almost nothing, really small runner. And then 20, 30 trades, you give 15 to 20% back to break even. That's a lot of profits accumulated that you end up giving to the market. You need to know that the market or the price moves with statistical limits. The moves that are happening every single day, they are statistical. They are not random numbers. And the average true range helps you see these numbers. And hopefully, by the end of today's webinar, you will know how to use the average true range to predict daily or intraday range. You will be able to identify trend days versus choppy days. You will be able to spot exhaustion, to spot great reversal trades. You will be able to avoid fake breakouts or low probability trades. And you will be able to combine the average true range with multiple time frame context. I'll show you how I do that, and if you're using multiple time frame analysis, you could be able to use that as well. And finally, you will be able to build realistic targets, and you will be able to manage your trades better in terms of partialing and in terms of adding to your winning position. What is the average true range? The average true range is measures the volatility, not the direction. And this is something that you need to understand. The average true range does not tell you where the market is headed. It just tells you the volatility. It tells you how much the stock typically moves. And how is the average true range calculated? It's calculated from these lows. High, low of the day, or the high of the previous day close, or the low of the previous day close. Let's say that you want to see or to spot the average true range to the long side. You need to see where is the low of the day today and where is the previous day close. And you start from the lowest point. If the low of the day is at 191, the previous day close at 192, you will probably use the starting point at 191 plus the ATR. So if the average true range is plus 4, 195 from the low of the day or from the previous day close. Let's say the price is sitting, for example, at 193 and you want to play it to the short side and you're wondering how far can the price go to the downside. You need to check the previous day close and the high of the day. Obviously the high of the day is 193. Let's say the previous day close is 194. In this case, you will calculate the ATR from the highest point minus the ATR, which means that the price could go all the way down to 190. So if I end up playing a reversal, for example, at 193, the maximum target needs to be $190. And the ATR is expressed as a price value, not a percentage. If you go to Trading Terminal, if you go to Dash Trader, any other website that tells you the average true range value, you will see that the value is displayed by a dollar number. 4.95, 3.21, 10.21. It's not a percentage value. And the average true range does not tell you where the price will go. This is something that you must remember. The average tells you how far it can go. That's it. Where the price is going to go to, that's where you use multiple time frame analysis, and that's where you use your strategy, your indicators. The ATR just helps you understand how far. Is this part clear before I head on to the next slides? All right, guys, don't hesitate asking questions real time. Good. So where can you find the average true range? Two places that are straightforward. You can go to tradingterminal.com, head to the fundamentals tab, check the ATR, and it will tell you how big it is in terms of value, 485 around here. The other way to do it is in Dash Trader. How can you add the average true range in Dash Trader? Right click on the volume bar, head to chart area. After that, config area, and add the average true range. Now in Dash Trader, you'll see the average true range shows like this in terms of waves. This is the latest value. That means that the ATR is around 4.5, but it's not exactly 4.5. It could be less, it could be more. It's an average true range. The ATR 14 calculates the highs and the lows for the last 14 days. You get a dollar value, let's say it's, for example, I don't know, 45. Divided by 14, it will get you some sort of a value, and that's the average true range. It could be more, it could be less. That's something that you must remember. So I usually don't go for the extreme high or the extreme low. I see the value that it's been sitting at most of the time, and in this case it's approximately 5.5 or maybe $5. That's what I'll be marking. This value is accurate, but it could be messed up sometimes. Any guesses? Sometimes when you get some news or the price gaps, you get one day where the ATR will be calculated from the previous day close all the way till the current price, which is maybe $20 or $30 because of the news, and that will mess up this value. That is why I do not love looking for the ATR using Trading Terminal or any other source. Not because they are not accurate, it's because it could be messed up because of the gap, and I prefer to use Dash Trader and use this value around here. Now, Sybil, Lead Belly, I will answer these questions going forward through the presentation, and if they are still not answered, ask me again, but that should be clarified within the next few slides. Ale is asking, would you consider pre-market and after hours price action in ATR calculation when volatility is unusually high? You could do that, but usually within the first 30 minutes to survive the pullbacks. But most of the time, according to the formula, the ATR is calculated from previous day close or high low of the day. Now, the average true range answers the most important trading questions. What are these questions? Is there enough room for my setup? Can I hold it for longer? Is it extended or it's too early for me to jump into the trade? Is this breakout real or I'm going to get trapped around here? Should I expect a continuation around here or maybe a reversal is more likely going to happen? Without the ATR, your targets are emotional. You are like, I already have 4 hours and realize I want to have 10 hours. Let me just hold on longer. You're just blindly doing it. Or I want to exit and lock in some profits. Why? Because it seems that I made enough. Stop losses are also random. I'll just double click around here and have my stop loss around here. Maybe it's too wide. Maybe it's too tight. Your stop loss needs to be technical based on the ATR as well. Not the daily ATR, ATR on another time frame. How do you use ATR across multiple time frames? I'll explain that today. And without it, you just rely on hope. I lost a lot. I really hope that it's going to run more so that I make up my losses. When in fact, maybe you need to take this trade, exit out of it, trade something else, and then manage the second trade until its average true range value is hit. The average true range is context. It's not a signal. So basically, don't mix the average true range with indicators. Indicators, they usually tell you when. If you use RSI and the RSI is around 20, it means that the price is oversold and probably it is time to play a reversal to the long side, for example. If you use MACD, the MACD values are also similar. They tell you that the price is about to reverse. If you use Bollinger Bands, and the price is sitting around the low Bollinger Bands, that tells you that maybe it's ready to bounce and to go to the long side. But the ATR does not tell you that. The ATR just tells you whether it makes sense to hold longer or it makes sense to look for a reversal,
Hey
or it
everyone.
makes sense to just bail out of your trade. And the average true range is not something that you use blindly on its own. The average true
I
range
guess
works
I'm just gonna stick around
with
till John
price
comes
action
in.
reading, with support and resistance
Neil.
levels, with trend structure, and that's how I do it with
I don't know
multiple
where
time
John is,
frame
but I thought I'm gonna
bias.
do the poll for him at least. I need to
The
figure
higher
out a
time
way
frame
to
for me controls the
this
game.
camera auto
It tells me
zoom
the bias.
or
The
auto
lower
zoom.
time frame is how I execute the trade. And the average true range behaves differently across different time frames, and it has a different purpose. For example, if based on multiple time frame analysis, I believe that today is going to be a long day. I believe that the pattern is just so obvious, and today the market is just going to rip up and squeeze to the upside. I will check the daily ATR. That tells me how far it can go to the long side. The 5-minute ATR, for example, is going to tell me how far the stop loss needs to be. Is it really tight or is it really wide? The 60-minute ATR could help me when I'm playing momentum play. Let's say I take a look at the daily chart. The daily chart is messed up. It just stuck sideways and I do not know where it's headed. It's just totally random. It's messed up. Maybe it's going to go up, maybe it's going to go down, maybe it's going to make half of the ATR move to the upside and the second half of the ATR move of the ATR to the downside. In this case, I do not use the daily ATR, I use the 60-minute ATR for a momentum play. I know that, okay, usually the first 60-minute candle is this big, so I'm not going to go for a daily ATR, I'm going to go for this one as a final target. If a stock has an ATR of $4 and the price moves from 1 to 104, can I expect a reversal back to 100, or does reaching the ATR level means the price is unlikely to retrace? Simon, that's a good question, and this is where I told you the ATR just tells you whether it makes sense or not. It doesn't mean that the price is going to go from 104 to 100. That's why you need to combine the average true range with price action. Reaching 104 means that the price needs to pull back or reverse. So I do not want to play a continuation. That's something I know for sure. Can I play a reversal? Yes, we are around a zone that could form a reversal, but I need a setup. How far can it go? You combine it with the levels. You don't play the full ATR to the downside, unless the daily chart screams that it needs to be a short today. And I'll show you some examples on this, and it'll also clarify this down. So if I take a look at Apple around here, I see that the average true range on it is $4.5 approximately, maybe to $5. This tells me that on average, Apple runs from 275 to 280, from 276 to 279, which is $3, from 280 to 285, which is $5, from 285 to 289, which is $4, from 284 to 286, or 287, which is $3. So basically it just tells me that it can run somewhere around this value based on the daily chart. But the ATR on the 1-minute chart, I use it differently. I mean, obviously, the smaller the time frame, the smaller the ATR. And I'm not going to play Apple to the long side targeting 13 cents. But this tells me something different. Could you guys guess? How does the ATR on the 1-minute chart help me manage my trade? Give a guess. Exactly. I know that on average, Apple runs around 15 cents per minute. And these 1-minute candles, sometimes they're spiky. You get an instant drop, right? Candle opens and it makes this 15 cents in a second. So this tells me that probably if I'm going to be playing Apple to the long side, I do not want to have a stop loss that's tighter than 13 or 14 cents midday, or maybe at least like 10 cents. Because if I end up playing it to the long side around here, having my stop loss down here, it could easily open and dump 10 cents and I'll be losing 2 hours. And I obviously do not want to have my stop loss like maybe 3 times of the ATR on the 1-minute chart. If the ATR on the 1-minute chart is 15 cents, I probably do not want to have my stop loss like 45 or 50 cents. I want it to be somewhere around it, maybe like 20, 25 cents. And in my opinion, if I play Apple, midday, 25 cents to 20 cents is an ideal stop loss. I do not use the ATR on the 1 minute chart at this stage because I can eyeball it. Visually, I can tell whether it makes sense or not. But for a trader who is beginner and a trader who is just starting to trade, you probably might need to have it in front of you just to get used to it. And then eventually you can remove it and rely on it visually. But the daily tells me how far it's going to run. So I could play it with around 20 cents stop loss, targeting a maximum of $4 move. How big is that? That's 20 hours. But obviously you're not gonna hold it blindly for a full daily ATR. It still depends on the levels, on VWAP, on the pattern, on the price action, multiple time frame analysis, etc. But imagine getting a tight stop loss based on the 1 minute chart and trying to get at least 50% of the ATR move. That by itself is already a good risk to reward ratio. So the daily ATR defines the expected daily range. And this tells us whether the price right now is early in the move, mid-range, or near exhaustion. And for me, this is how I utilize it. If I take a look at some particular stock and I see that the market opens and we're sitting at an area within 30 or 50% of the ATR, I know that there is still room to move. I know that if I play Meta, which has an $18 ATR, for example, and right now it has made only like $6 move, it still has $12 in it, and I could capitalize on that. But if, for example, the market opens and I see that Meta has made $14 move on an $18 ATR, I know that only $4 are left, and there's probably no need for me to trade it because the risk to reward is just not there. Probably I need to look for something else. 100% of the ATR at the open, which happens a lot of times, means that there will be a lot of traps. People get emotional. They see the market open, they see a really big 1 minute candle, and they're like, oh, this stock is really strong. It made a big opening range breakout candle. I probably want to be in it before I miss the rest of the move. And then you get as big as a candle to the opposite direction. And that's where you just simply get trapped because you played size of the candle and you were impulsive, playing what you see in front of you without aligning what you see in front of you along with the average true range. So the daily ATR could help you avoid bad trades because there are some common mistakes. One of the mistakes, and I mentioned it on the previous slide, is chasing breakouts after the stock has made 80 or 100% of the ATR. Most of the time, you are going to have a big pullback and the risk to reward is just not there. Another mistake is holding winners expecting more than the market usually gives. And you know when this happens? This happens when you had 2 or 3 trades, all of them were losers. Then you get into a 4th trade that's finally starts running and you're like, okay, this is the trade that I'm going to make most of my losses back and I'll get back into the green. That trade hits the ATR, but it is not enough for you to make up for all the losses. And you're like, I'm gonna hold longer. I'm in the right stock. I'm in the right move. But the stock already has hit its ATR. You need to bail out of it because now it's probably going to top up and probably it's going to start reversing. And then finally the trade that you caught that made a nice move that hit the full ATR ends up being a break-even trade or a small loser as well, adding into the previous losers. Another mistake that's happening is people looking for reversals early in the session. Sometimes the market just opened, it made 50% of the ATR move and they're like, oh, there is a double top setup or a double bottom setup or a head and shoulders. That's a reversal pattern. Let me try play a reversal on it. But it's too early. There is still room for the stock to run. You don't want to be too early in reversals. Wait until the ATR is hit before you start timing the reversals. Basically, let the ATR filter your trades because not every setup deserves execution. If you see a double bottom, that doesn't mean that it is a long setup that you want to be in. This is a good example around here. The Tesla's ATR, if you just take a look at it, it's approximately around $16. And if you take a look at it around here, it's $9.55. It's still earlier in the session. market is still volatile. There is a lot of momentum in it, and people are like, okay, strong stock today, bull flag or ABCD pattern. I'm gonna play it to the long side. The ATR is $16 and it already ran from 446, which is the low of the day, right? All the way to 462, which is like $16, 100% of the ATR. You end up playing it to the long side for a bull flag and it just simply reverses. And that's a common trap. It happens a lot of times. So was this bull flag a good bull flag? Yes, it was a 5-minute opening range breakout and there was still room left in it to go to the long side. Was this bull flag a good flag? It was okay, not the best, because most of the ATR was already done. But if you think that you can squeeze some momentum out of it for whatever is left based on the ATR, you would give it a try, but it's riskier. Is this bull flag a good flag? No. First of all, it's the third leg on a stock that already has hit its ATR, so probably it's going to be a trap or a reversal. How does intraday ATR help you? Intraday ATR helps you kind of identify trends, maybe spot range bound conditions on charts that are choppy on the daily chart, or it could help you decide whether you want to play breakouts, reversals, or maybe just stand aside. For me personally, if the higher time frame range is completed, the lower time frame trades lose their edge. You don't use setups, whether it's pivot point setups, tape reading setups, bull flags, bear flags, ABCD patterns, after the range is already completed. You don't have statistical edge around here. And trading is not only about the setup and it's not only about pulling the trigger. It's about way more than that. For me, and this is a good tip for you for the future, is using the intraday ATR, which is a 30-minute, to determine opening range breakout final targets. This is a trade that I've taken, I think, less than a week ago on AMD. How did I decide my target at 222.50? I opened AMD, and here I don't use exactly the average true range. I'll show you a trick that also gives you some sort of an average true range based on the time of the day. And I'm like, how big is the first 30-minute candle on AMD on day-to-day basis? I'm like, okay, on this particular day, the first 30-minute candle on AMD is somewhere around $4, right? On this day around here, the first 30-minute candle is around $5. On this particular day, the first 30-minute candle is around $3. On this day around here, it's probably around $3 as well. On the day before that, it's somewhere around $4. On the day before that, it's $5. So I could tell it's an average of $4, right? Sometimes 3, sometimes 5, sometimes 4. I'm playing AMD on the 12th of December. I take a look at the daily chart and I see that the daily chart is flat. I mean, there is a red candle followed by a green candle, followed by a doji, followed by a red candle. And the worst part about these type of daily charts is that they could start with a strong volatility to the upside, make a part of the ATR move to the upside, sell off all the way to the low of the day, and make the second part of the ATR to the downside. It's difficult to tell which direction the stock is going to hit its full ATR to. But the 30-minute pattern on AMD was so clear for me, and I saw, based on the statistical edge, based on the data from the past few days, that normally AMD at the open makes around $4 move. That means that today it could go from 218 all the way to 222. And I know that my final target on AMD needs to be around 222. I will probably lock in some profits along the way. And for my final target, it's either 222, or I could stretch it a little bit if Atlas shows me that, or if there is an automatic level ahead. That's why I exited on 224 to 40ish. Traders who don't use this technique, who do not use the ATR, will be like, oh, this stock is really strong today. That's the first leg up. Probably it's going to make a second leg up before the continuation. I will leave 30% of my position for the next leg to the upside. price goes against them, and they're out at break even, giving 30% away for the market. When in fact, on this particular day and on this particular case, there was no point holding it for a second leg up. This is the type of trade that you want to jump in and exit all out around this 30-minute ATR value. Derek is asking, do you use the average true range during earnings, Fed news that has a huge spike? The spike usually moves twice or three times the ATR. Derek, look, the ATR usually is kind of relative to the relative volume. So if the R vol is more than 1 or more than 100%, the ATR could be more than 100%. If the R vol is less than 100%, the ATR could be less than that as well. So on 150% relative volume, on a stock that has a $4 ATR, I could expect it to make $5 or $6 move, for example. But I will be using this to have my final exit, for example, from trade. I'm not gonna use it to jump into the trade after it's made $4 move, but I could stretch my target based on the relative volume. I will also use it for reversals. I'm not gonna play a reversal on a stock that hit $4 move when the relative volume is 150%. Since the relative volume is high, I know it could make a move past the ATR, so I'll probably wait for like $6 move before I play a reversal. Does that make sense? So you're using the first 30-minute candle at the market open to work out the average true range. Alex, if the daily direction is not clear. If the daily direction is clear, I don't use the 30-minute ATR, I use the daily ATR. And I'll show you that example in a bit. How can you tell that we're going to have a trend day or a choppy day using the average true range? Normally, when you get an early expansion of ATR, for example, the market opens and within the first 15 to 30 minutes, we get around 50 or 60% of the ATR, that tells me that we could have a trending day. Not only that, the pullbacks are shallow, you get multiple legs to the upside, the price respects VWAP, respects the moving average, 920 setups, 9 on the 5-minute chart, etc. On a choppy day, the market opens and it starts stalling. Like it starts stalling after making 20-25% of the ATR. You get one big candle followed by one big red candle. You get a break to the upside, instantly buy a move to the downside, a break to the downside, instantly buy a recovery to the upside. So by knowing this around here, you could survive some sort of chops. And let me give you 2 examples around here before I go to the rest of the questions. This is a good example of how I managed Meta, not using the 30-minute ATR, but using the daily ATR. I take a look at Meta on the daily chart and I see that this thing is in a general downtrend below the 50 moving average or the 200 moving average. It was making higher highs and higher lows until it hit the 200 moving average on the daily chart. After it hit the 200 moving average on the daily chart, it stalled for like 3 days. Every time it goes to it, it rejects it. It tries to break, goes above, and it rejects it. Previous day closed as a reverse hammer. What does this tell me? Where is the market headed today? Just based on the daily chart. Where do you think the market is going to head today? Not using the 5, not using the 60, not using the 1-minute chart. You see a price slightly making higher highs and higher lows, hitting the 200 moving average, stops and keeps rejecting it for multiple days, closing as reversal candles. Downside. How far can it go to the downside? That's the second question. Come on, guys, you have everything in front of you. Exactly, ATR, which is approximately around $15 to $16. Then I use some other information that I'm not going to be able to cover everything in one single webinar. Multiple time frame analysis, reading price action to decide the setup and draw the levels on the 60-minute chart. But anyway, I end up playing Meta to the short side. I see that the start of the move is approximately around previous day close, the highest point, right? Serino, as that will answer your question. How will the ATR be calculated when the market gaps up or gaps down? Previous day close is 667. And we're opening at 664. Where will we calculate the ATR on this stock that gapped? Where will we calculate it from? from previous day close, exactly. So we will be like 667 minus 15, which is 652. That's the final target. I do not go for 100% of the ATR when I'm trading. I usually go for around 80 to 90 because, like I told you, ATR is average true range. It could be more, it could be less. You pay attention to the relative volume, you pay attention to moving averages, you pay attention to levels, because average true range is not used on its own. It's used in combination of price action, levels, multiple time frame analysis. But I played it to the short side. I locked in some profits. I see a reverse ABCD pattern or a bear flag, and look at these guys. This is a sign of a trend day. Early expansion of the ATR around 50 to 60% within the first 15 minutes. So the price here on Meta went from 667 all the way to 661 at the open, and within the next minutes all the way to 656. So basically we made somewhere around 60% within the first few minutes. Pullbacks are shallow, respecting VWAP and moving averages. So the pullback is really shallow. It's respecting moving averages. I add to my position. That's also a 3-bar play to the downside, and I'm targeting 80% of the average true range, and I'm all out on this particular day. A choppy day, characteristics are this. Market opens. Within the first few minutes, it makes around $5, which is like 30% of the ATR. Big dumps through moving averages, not respecting anything, and what happens throughout the next of the day? Choppy price action. It does not hold the choppy price action for the whole day, by the way. Most of the time, especially if the daily chart looks good, it's going to break up or break down sooner or later, but I know I should not force it at the open. I'm done with it. I played it, I hit the level, and I was just out on this trade. So to repeat this, the ATR must be read with structure and not alone. Use multiple time frame analysis. Use the ranges, highs and lows. Use prior day levels. Use VWAP and key moving averages. One of the ATR most powerful uses is signs of exhaustion. So if I see that the price hit 100% of the ATR to maybe 80% of the ATR to maybe 100% of the average true range, if I see that along with that, the candlesticks are starting to get smaller, which we call shrinking candlestick pattern. I explained that in my webinar, different candlesticks and candlestick patterns. You see volume climaxes, spikes in volume. You see wicks appearing around the extremes. That means that long move is probably done, and we are setting up for a reversal. Do you always play a reversal simply because these signs are there? No. You need to use multiple time frame analysis, and you need a bearish pattern, and you need to play a reversal on a day where a reversal is more likely. I'm not going to be playing a reversal on a stock that breaks all-time high that is really strong today simply because it hit its ATR and it looks like it's topping out. Because sometimes stocks never reverse. They could just simply hold around highs for the whole day. I need to make sure that I'm playing a reversal on a stock that's messed up on the daily chart, doesn't have a clear direction. Or I'm playing a reversal into the direction of the overall trend. High probability reversals happen when the higher time frame average true range is nearly completed, when the lower time frames show you failure, when you are playing against trap traders, and when you are playing into the direction of the higher time frame, which is an extra note around here. The average true range in this case will help you avoid early counter trend trades rather than trying to time a reversal on every single wave to the upside. You know that it's too early, it's too early, it's too early. All right, we are hitting the ATR. Now I can watch it, not play it. I can start watching it for a reversal. And you enter only when the odds shift. And I talked about this in the chat room today. You probably want to see some new specific behavior for the price action. If it was making lower lows and lower highs for the whole day, and now it's finally giving a double bottom, volume spikes, ATR is hit, 15-minute reversal candle, all these combination tells you that this looks like a decent reversal. Will it work? Not necessarily, but eventually you need to make sure that you're managing your trade based on a good risk to reward ratio. This is one of the reversal trades that I played, and look at all of these indicator combinations around here. BTU on the daily chart is in an uptrend, breaking a multi-month level, pulling back into the 9 moving average. And if you watched my ABCD pattern webinar, I mentioned that if the price holds the 9 moving average, probably it is going to continue because the 9 moving average is a trending moving average. I know that we're sitting around the level C. I'm not gonna play it simply because we're sitting around the level C. I need more structure. I see a level on the 60-minute chart. I take a look at the ATR and I see that it's around 80 cents to 90 cents, and we sold off from 25.90 to 24.80, which is $1.10, more than the average true range. I see volume spike around the level, and I'm also a trader who is playing a parabolic reversal setup. If you bought my course Extreme Reversals or you watched my parabolic reversal webinar, you might have noticed that one of the most important criteria that I'm looking for when I'm playing parabolic reversals is 3 consecutive candles, followed by an extension from the 9 moving average on the 1-minute chart, followed by a red to green move on a huge volume in combination with the ATR, with the overall bias based on the higher time frames and the level. That's how I ended up playing it to the long side. Now question. All right, Eamon, the ATR is 70 cents. Why are you not playing it from 24.70 to 25.40? Because according to my reversals rules, final target on a reversal is usually VWAP or the time frame that is extended, which means maybe 9 moving average on the 15-minute chart or the 9 on the 60-minute chart, or somewhere around 40% of the whole move. So if the move was somewhere around, let's say, $1.10, my pullback would be somewhere around 40 to 50 cents, which in this case was around 40 cents. Why is that? Statistical edge. I noticed that reversals or parabolic reversals, they are usually working out, the movement that they usually give you is somewhere around 40% of the pullback, not full ATR, unlike breakouts that I'm playing on a good daily chart. So the ATR giving you a statistical edge that needs to be combined with your skill reading multiple time frame analysis and knowing your setup. Elements on Fibonacci calculation. You could say that, Sean, and this is why I also mentioned that back in the chat room. There is no magic indicator, not pivot points, not multiple time frame analysis, not Fibonacci lines. Every trader uses some specific indicators or tools in their trading or when they are trading, and over time you start spotting specific price action behavior around the tools that you are using, and you develop your trade book around it. So believe me when I tell you that Fibonacci lines are just a tool. They are not better than moving averages. Pivot points are just a tool. They are not better than, I don't know, reading the tape or plain chart. All the tools are equal. It's how you use them and how good you are at reading them. So if you feel that one of the indicators in there or the tools that you are using is too complicated for you, use the tools that make sense to you. Not what I'm using, not what Thor is using. I'm not promoting anything around here. Use whatever makes sense to you. Are you aligned with my trading style? Are you aligned with Paris's trading style? Are you aligned with Andrew's trading style? Stick to that. That's all. So ATR based target settings. You don't need to guess targets. For example, if you're playing a stock that looks really good on the daily, partial at around 50% of the ATR, final target around 80% of the ATR to 100% of the ATR. Trail only if the market has, for example, a high relative volume. Let's say, and this is one mistake a lot of traders are doing. I will use trail stop loss, they tell you. The price starts to trend, they use trailing stops, they get stopped out instantly and then they are out, or they made a small move. You don't want to start trailing your stop losses right after you get your entry. Partial here, partial here. The price goes past the ATR, the relative volume is high. Now use the trailing stop loss. This will improve your risk to reward ratio, it will add the consistency, and it will help you hold yourself in control or hold your emotions in control. And I'm not gonna go through this example one more time. I already covered meta and everything that I did and how I decided my target using the average true range. So average true range helps you standardize the risk. stop loss should make sense relative to volatility, and we talked about that in Apple. If the average true range on the 1 minute chart is somewhere around 13 cents, then you don't want to have a 5-cent stop loss probably, and you don't want to have a 50-cent stop loss. Tight stop losses in high ATR markets will get you wicked out. Wide stop loss in low ATR markets are inefficient because your risk to reward is going to be horrible. You're not going to get enough risk to reward ratio even on a big move because your stop loss was wide. You need to adapt risk to the conditions, not to your emotions. I'm not gonna have a tight stop loss because I had so many losses before and now I need to make my losses back. I'm not gonna have a wide stop loss because I'm afraid of getting stopped out, and then you get nothing out of it. Trading is fully technical, systematic, and it's literally a game of numbers. Once you accept that, your trading is going to move on to the next level. This is another example of how I used ATR timing this reversal. I see that the average true range on Riot is around 80 to 90 cents. I see that the daily chart is messed up. There is literally no trend, no direction, nothing on it. It sells off somewhere around 60 to 70 cents, which is not bad, honestly. I mean, close enough to the ATR value. On the 60-minute chart, there is an obvious level. Every time we reach it, we reject. On the 5-minute chart, there is slight. On the 1-minute chart, there is volume spike along with a parabolic reversal entry criteria. I see that this is approximately the size of the 1-minute candle, and that's what I need to use as my stop loss. I played it with a really tight stop loss, and what do? Target 50% of the move on this parabolic reversal. So don't use the average true range as an entry signal, that for sure, because like I told you, ATR is a context. Don't ignore higher time frame ATR. It tells you how far the stock can run. Don't trade extended stocks if the ATR is already done simply because the setup is there. Don't expect a continuation when there is exhaustion, when you need to start looking for reversals. Don't treat all the stocks the same. One stock has $20 ATR, one stock has 15 or 20 cents ATR. The ATR is just a decision filter. It's not a magic line. So in short, what you want to do is build your bias based on the daily chart, for example, or on the 60-minute chart. That tells you how far the stock can run, especially when the higher time frame is clear. Make sure to measure how big the ATR is and how much is still remained. Build your plan. Am I playing a trend continuation, a breakout, and that remaining is going to be my target? Or maybe the ATR is already almost completed, so I might want to wait for a reversal, especially that my bias, for example, also supports a reversal. Then use the lower time frames for an entry based on the setup that you're playing: double top, parabolic reversals, head and shoulders, opening range breakout, etc. Make sure that you set a realistic target based on your bias and the time frame that you measure the ATR on. You are measuring a daily ATR, the setup looks good, intraday it looks good, that's perfect. The daily is messed up, but the 30 looks good, then go for a lower ATR. And then just manage the trade based on these expansions. This is how you make the context and then you trade the execution. So in short, using the average true range will keep you out of bad trades. It will help you time your entries, understand when to play a reversal rather than playing a late or an early reversal. It will help you get realistic targets, not something that you're hoping for, and it will help you survive traps like trend continuations on a stock that is already around a strong level that already made the whole ATR move. If you want to take your trading one step further, learn how to read the price action, how to build the bias, how to identify which direction, which stock to play, you can check my trading terminal course. There was no discount for a long time, so you can use this promo ATR40 for a 40% discount. And along with that, you'll be getting access to the Discord server where I share some of my trade ideas along with the targets and the levels. There is a good community of members who are also sharing some good trade ideas, and access to the monthly group mentorship sessions. This is the end of the webinar, so let's go for your questions, guys. Now we still have some time. and let's cover your questions. Sean is saying, I find it hard to profit from low ATR stocks. Just takes too long to meet the target. You're right with that. So on low ATR stocks, you probably want to have tighter stop losses, like 3 cents, 5 cents, for example, just to make sure that you got the move within the first 30 minutes. To be honest, usually somewhere around 70 to 80% of the ATR is hit within the first 45 minutes. Sometimes when the market opens and it starts chopping around 25% of the ATR, the move is going to happen later by 11, 12, or 1 p.m. Eastern. So if you see that stock is chopping around for the whole day until the afternoon, expect that it is going to burst up or down. This is how I timed my Tesla trade a few days ago. Let me just open it and share it with you. 1 second. I think it was somewhere around... and we also called it in the chat room, if you remember that one, right? It wasn't this one. Yeah, it was this one around here. So I took a look at Tesla during the chat room a few days ago. It was on the 16th, yeah, a couple days ago. And I see that Tesla has made an $8 move on a $16 ATR. And I see that within the day, it's just chopping around. And there is still a lot of room left based on the average true range. And I noticed that we're sitting within the beginning of the move on the 60. There were big orders on Atlas up there. It's holding VWAP. It's respecting the 20 moving average and the retest area since the open. And the moment I confirmed that the setup is there, that the 15-minute chart looked good, I played it to the long side. I locked in obviously some profits based on levels, but I did continue holding it until the ATR value. One thing though, the relative volume was slightly high because it was 3 p.m. and the ATR and the volume was already average, so I decided to leave a smaller position, like we said, trailing it, right? If we go past the ATR, as long as it keeps going in your favor and the relative volume is high, you could continue holding on to it. You remember that one, Sean? Yeah, it was actually a good one. Lead Bill is asking, so when you look for a trend day, you look for price stalling on the daily or ATR stalling on the daily. When I look for a trend day, I look for a clean daily candlestick pattern where I'm confident that based on this pattern, the price is going to go up or down. That's what I'm looking for when I'm playing a full daily ATR. I explained that also in my course. There is a section in the course that's called predicting the next candle. How can you tell whether the next day is a long day, a short day, or maybe a skip day, a day where you do not know where it is headed. That is there are a certain set of rules that you follow to predict the next daily candle, and that helps you understand whether it's a good one to play based on the daily or not. Without these rules, there are some certain days where you can tell with confidence. For example, why was I confident about this Tesla play on this particular day? I was confident about it because of the daily chart. You could see the day Tesla, and this is like simple one. Anyone can tell it. We were sitting below this level for 3 months. Yesterday we broke this level with an increasing volume, which tells me that today most probably it's going to continue. This piece of information tells me that today is a long day, and we're probably hitting the full ATR between 18 to maybe 20 or $22. That tells me that we're probably going to have a trending day. There are more complicated rules, especially when the market is sitting within ranges or when the market is not trending on the daily chart. Can't go over all the nuances right now, but you can at least use this rule on a daily chart where the direction is so clear, like that Tesla, for example. Any more questions, guys? If not, I hope this was helpful. I hope you enjoyed this webinar. If you get any questions after this, feel free to email me, ayman@bearbultraders.com. Good to see that the attendance was big, and you can start practicing this, and the recording will be uploaded to Trading Terminal hopefully within the next couple days. And I'll see you in the chat room, guys, in a few minutes since I'm covering for Megan. See you guys.